Hello and welcome. Alan Nuckman here from Bullseye Option with our webinar for this afternoon, How to Use Market Fear to Profit Right Now. And today's a great example of what I'm talking about. Couldn't have drawn it up any better on the chalkboard as far as the market movements we're getting, and that is opportunity. We'll get into that in a second. Let's just confirm a couple of things here, that my audio is working fine and everybody's settled in and concentrating on what's going on here today. Thank you. Appreciate it. Appreciate it. Thank you. All right, so let's get focused and spend some few minutes here going through some strategies to take advantage of what the market's doing right now. And let me just move this window, make sure we are capturing this. So there will be a recording that will get this sent out, emailed out. Let me just double check that we are recording. Yes, we are recording, so all is good. Okay, my name's Alan Nuckman. I'm the host this afternoon. I'm the chief strategist for Bullseye Option. We'll talk about myself in just a moment, but let's talk about the markets, because that's why we are here. And today, the past couple of weeks, we've seen some market movement, and that's what we want. This is the best time in history for traders and investors. And I use the words investors and traders interchangeably. A trader is someone that has a plan to make money. An investor just wants to make money. So being termed a trader is actually a compliment, because they have an entry strategy, an exit strategy, and a risk strategy. Whereas an investor, they want to make $1,000, they want to make $500. But now is by far the best time because of what's happening in the marketplace. Just want to double check. I got a little alert here that my microphone is a little loud. So if you could just confirm, and I will back it down if I can do that in the audio here. Back it down a little bit. There we go. Okay, there we go. I think that should be good. All right. So let's talk about why it is the best time ever. Well, there are a multitude of reasons, mainly because of the technology. The electronic markets have changed the playing field. They have leveled the playing field for everybody. There was a time that the floor traders had a major advantage in the fact that they had the access to the opportunities at all times. Now, at a click of a button, you can trade any market, any direction, any time, and it's much different than it used to be. When I traded on the floor, dabbled on the floor in the treasury pits, if there wasn't market movement, you had to go somewhere else. You couldn't just walk into the crude market or the soybean market and start trading. You know, those guys in those pits had their rights and had their territory, and you couldn't just pick up a computer and start trading, whatever was moving. So things were much different back then. Now you can trade on a screen, any market, anytime, any direction, up or down, at a whim. Also, the commissions are very low. Commissions, unfortunately, are a cost of doing business, but they do perform a function in the fact that they make you think, or hopefully they make you think, before you put on a trade, as opposed to just getting in and out of the market if it didn't cost you anything. So it requires a little discipline if you have to factor in the commission costs, and those are now $5 or $10, so they're a very, very small part of your overall costs, but they do perform a function. Also, what's revolutionized the markets are these tight bid-ask spreads. A lot of stocks trade in pennies. A lot of options trade in pennies. There are a lot of buyers when you want to sell. There are a lot of sellers when you want to buy. These tight bid-ask spreads and this increase in volume means that you can execute your disciplined trading plan. That's very important. You come up with a plan, you plan your trade, you trade your plan. And also, because of those tight spreads, you're able to control risk. That should be the number one focus for any and all traders and investors, is what is your risk on a trade. That's the difference between a novice trader and a professional trader, is those who focus on risk. When you're wrong, you have to have a quantifiable risk control plan in place, so no one trade is going to have any detrimental effect on your overall portfolio or your overall month or year or decade. So risk control is critical, and that's where you need to focus. You need to know what your maximum risk is on each and every trade. So hopefully today I'm going to share a couple of things with you, a couple of my little insights, my little secrets, but when you walk away, I want you to have a better attitude as far as the optimism about the opportunities that exist. The markets are not good or bad. The markets are the markets. There's always opportunity, and the more market movement we get, the more opportunity that is to take a high probability piece out of the overall movement. So we want the markets to move. Volatility is not scary, and today I'm going to show you a couple strategies that take advantage of volatility that really, really help our odds. But my secret for today is to have a better attitude about the markets always offering opportunity. I don't care if the market goes up, down, or nowhere. There's always going to be some money to be made. So if we look at the market for the course of the year, we moved up. We traded sideways in the S&P for the last 6 months, and then we broke to the downside. That's essentially what happened. And if you think about it, to put it in perspective, the stock market bounced all the way back to 2000 just last Thursday. So a week ago today, we were back up to the 2000 level. So had recovered a significant amount off those bottoms. And if you remember last October, the same thing happened. Every sell-off we've seen in the market over the last 5 or 6 years, every sell-off has bounced back and made new highs, and actually a measure move technique to take the distance of the sell-off on top of those old highs projected the next upside target. Now, that's not going to work forever, but in the meantime, until the fundamentals change, I think you still have to respect that, and that recovery that we saw in the market in a period of 3 weeks was rather significant, and it's what we've seen in the past before, that when we get these corrections that money is still chasing yield, and right now the stock market is the best performer as opposed to treasuries aren't going to give you any return. The stock market has been a solid performer over the last 5 years. That'll change, and when that changes, strategies will change. But for right now, you still have to respect the upward momentum, and as of last week, we were unchanged in the last 52 weeks on the S&P. So what we did was we gave back gains, essentially is what happened. We gave back gains. Yes, it felt bad for the bulls, but there was opportunity on the downside. But the downside moves, you've got to be very nimble in the fact that you've got to take your profits quickly, because in the past, they've all evaporated. So we will see what happens in the future. But today I want to talk about one factor that we're going to focus on is volatility. And volatility is just another word for opportunity. We want the markets to move. As the markets move, we're going to take our slice out of it. Now, if we look at volatility, the stock market's been on a 5-year uptrend. Volatility's been on a 5-year downtrend. And just in August, it got down to 1088. Now, we did have what I would call a VIXplosion. The VIX is the measure of volatility. Some people call it the fear index. It's one of the components that prices an option, so it's important, but I think it's reflective of the stance of the markets. And you can use that to help you decide which tools in the toolbox to use in the marketplace. And increased volatility gives you a whole lot more tools, and we're going to talk about a couple of those strategies here today. But if you look at the VIX was at 1088, exploded above 20, and then rallied up to 53 on that August 24th, Black Monday day. But if you look at the VIX now, even with the bit of a bounce that we've seen in the last couple of days after the no action by the Fed, the VIX is still half of what it was at that extreme high. So it's coming back down. Every time the VIX has popped up in the last 5 years, it's kind of like whack-a-mole. It's gotten beaten back down, and the overall trend is still down. So you've got to respect the downtrend in the VIX and the uptrend in the stock market until proven otherwise. So a quick little rundown about me. I've been doing this for about 25 years. I started on the floor of the Board of Trade as a runner, as everyone does, regardless of education and experience. You just had to learn by doing in the old days. And to go back to one of my pit stories is, before technology advanced to where the opportunities are today, I often would get a phone call in the afternoon, and it was my girlfriend, who became my wife, calling me to see why I wasn't at work or what I was doing. And I would have to tell her that I was saving money by not being in the pit trying to force trades. If things aren't happening, you know what happens when you try and force trades? Losses, usually. And so I was actually saving money by hanging out at Wrigley Field, because I lived up by the ballpark and I could watch Cub games and not force trades. So the lesson to be learned is now there's always something to pay attention to. There's always a marketplace to try and take advantage of. Like I said, I worked on the floor. I've been in the options markets. I've traded anything and everything. It's not so much what you trade, it's how you trade. But what I've found over the years is that options offer the best vehicle for many reasons, for probability. And that's one of the secrets that I'm going to talk about here today is how to use probability. So when you walk away, I want everyone to think to themselves, well, great, now I understand how important probability is, and I can focus just on that and take a lot of the emotion out of the markets and trade with a more, I would say, disciplined approach, a more methodical approach. So that's very, very, very important. I do a lot of TV. I'm on TV a couple times a day at least, giving my commentary. But the first thing I tell people is don't watch TV. Don't watch CNBC. Don't watch Fox Business, because their goal is to get you emotional and on the edge of your seat about each and every piece of information, every news bit, every financial number, so that you maintain, that chain, that link to your TV, and you never turn it off. So they're going to get you very emotional, and that oftentimes makes you stray from your disciplined trading plan. So understand what that is. A lot of it's infotainment. When I go on the air, I try and give very specific stocks, ETFs, markets that I'm looking at, where I want to get in, what I want to risk, how I want to play it. So I'm giving actionable trades that people can evaluate for themselves, see if it fits their risk profile or not. I'm not just talking platitudes about, the big macro events or the stock market feels like it's too high or whatever the flavor of the day is. I want to give actual results. So, if it helps, I think it's beneficial for a lot of people to just turn the TV off. So anyways, let's talk today about how to use market fear to profit right now. Because unfortunately, a lot of people are very, very fearful about what the market is doing. Fear is a natural emotion, but we need to minimize it. Let's focus on probability. Let's focus on strategies that can utilize others being fearful, and that's what we're going to talk about today. Stay till the end of the presentation. I'll give you my latest trade that I just did this morning on how to buy a stock at 13% lower or get paid 5% in a period of 3 weeks not to. So it's a simple probability trade, and we're going to get into that strategy in just a moment, but I have a specific example that I think has some great mathematics behind it. So let's talk about a couple things. First off, I want to talk about time. People, I guess, in general, I could be accused of this as well, don't appreciate time as an asset. It's our greatest asset. It's what we focus on in our life, and it's very important in the marketplace. We want to use time and probability in our favor. I think that's very, very important to focus on maximizing the time window of that opportunity and using probability to increase our results. You buy or sell a stock, you got a 50-50 chance it's going to go up or down. There are many, many strategies you can choose that'll have 70%, 80% probability. I want to put odds on my side, and hopefully you do too. Trading is very simple. The execution of this methodology may not be, because there's emotion involved and greed and fear and other factors, but trading is very simple. You need to focus on very few things. Your trade cost, what you're risking, what that risk reward is, what your probability is, and what your break-even point is. If you can evaluate each and every trade objectively using this methodology, you'll be more successful. You're not factoring in your opinion or what you think the market should do or what it needs to do. The market doesn't need to do anything. It can do anything it wants. The fact is that people are trying to put rational reason on a marketplace that is a collective of everybody's emotions and actions. That's a whole another psychology lesson that we'll have to get into. But I think you need to understand yourself and the psychology of the markets to be able to have this discipline in this methodology. So let's talk about a couple of things to start with, because I already mentioned options. Options are the vehicle, and options aren't scary. So let's get into some option myths and some of the reasons that smart people like you have it wrong about options. So most people think options are complicated. They're not. It's just a matter of picking the right strategy, up, down, or nowhere. You can profit from a direction. You can profit from where the market doesn't go. That's one of the strategies we're going to talk about today, that you can profit from where the stock doesn't go, the stock or ETF. And there's another strategy, the other strategy, where you will profit if the stock goes up, the stock goes sideways, or the stock goes down, as long as it doesn't go below your break even. So 2.5 out of the 3 possibilities work in your favor. Number 2 is a lot of people think incorrectly that options are a gamble. We want to understand probability. With options, you can know what your probability is on that trade. Okay? Are you the type of person that wants to take long shots and trade, out of the money short-term options that are just a gamble that have maybe a 5 or 10% chance of hitting it? We call those lottery tickets in the business. That's not where you're going to be successful. You swing for the grand slam, you're going to strike out a lot. So I want to trade, at my age, I want to trade probability. I want to have a probability of 70-75% on each and every trade. If I'm wrong, I'm wrong. I can live with it, but I want to put the odds in my favor. That's what's important. With options, you can very easily know what your probability is. Number 3, time. Unfortunately, like I said, a lot of people buy those short-term options because they're cheap when they start off trading options. If they're a call buyer or a put buyer, they buy very little time. Buy more time than you need. The price differential between buying a 1-month option and a 3-month option is not that significant. The price differentiation between buying a 3-month option and a 6-month option is not that different. And especially with volatility, or it was at historical lows, that component, that volatility component, meant that time was rather inexpensive compared to what it was 5, 6, 7 years ago. So my lesson we learned is buy more time than you need. If you think an event's going to happen between now and October, Buy January just in case. For an extra $20 or $50, it's certainly worth it. Even if you don't use it, you can unwind it and sell your position at any time. It's better to have more time than what you need. So to use that example as time is your greatest asset, I often get a little bit of ribbing from my trading friends and associates that I buy long-term options. So I'm buying January of 2016 options or March options at minimum for new long call positions. So, you know, the idea here is to use a stock substitution strategy to buy an option that's going to act like the stock. It's going to have less risk. It's going to have less money tied up. It's going to act like the stock in my performance, but I have much less risk. So a good example of that was XLF. XLF is the ETF that tracks the financials. And as we know, obviously the financial crisis, the bank stocks got hit hard, and they never really recovered like the rest of the market did. So they still have more upside potential in my opinion. But if I go back to a chart, there was an entry in October of last year. You can see that yellow bar. Didn't buy at the bottom, but bought in that yellow box, bought a call option to give me the right to be long. But what was important was that it was a January of 2016 option, that it had plenty of time for development. Okay, and for a while the market moved up and then it traded sideways. I had my target price in there, but I had a significant amount of time for things to happen. And buying the option was a great vehicle as opposed to tying up the money in the shares, buying a call option in this example. So the exit, was in July. According to the plan, as I talked about, I had my exit strategy when the option gained in value 50%. That was an out, all right? So it's not an active trade. You don't have to be active when you trade options. You can use options just like you would stocks, depending on your time frame. Are you a swing trader? Are you a long-term trader? Whatever. So this option, the exit on that, you could see that there was plenty of time, with that. So it was a 50% return. Bought the option for about 4.25, got it about 650. But look at the amount of time. So it still expired in January, so it still had another 6 months left of time, but that option went through October, November, December, January, February, March, April, May, June, and July. So I was in that position for 10 months, all right? My maximum risk was $430, and eventually it achieved my objective. But that's an example of buying more time than you need, and some people are going to say, well, that's not really it. That's more of an investment than a trade. Well, yeah, it is a trade. It just happens to be a long-term trade that I had enough time to be right, and I was correct in the trend and looking for that market to move. So that's an example of using time in my favor. Another factor here is a lot of people think that options are risky. The vehicle is no more risky. It's no more risky to trade an option than it is to trade a currency or to trade crude oil or to trade Microsoft. If you don't understand discipline and you don't have a trading plan, it's not what you trade, it's how you trade that gets yourself in trouble. So options inherently are less risky because if you're an option buyer, your risk is limited to whatever you pay. No matter what happens, the worst thing that can happen is if you buy an option, it can go to zero. You buy a $100 stock, yeah, it can go to zero, but that's $100. You buy a $300 option, or a $3 option, which is $300, it can only go to zero and you'll be out $300. So the risk exposure is less, and like I said, focus on controlling risk. So it's got that inherent risk control built into the price. Another factor is, and I think this is one of the greatest factors, and this is my lifestyle's changed, so this has been important to me, that people think that options management takes too much time. No, it does not. The option strategies I use some shorter term monthly strategies, and I'm using longer term strategies for the next 3 to 6 months. I'm really looking at those on a weekly basis. On a weekly basis, I'm evaluating where they are, how they performed on the week. I'm not making any decisions based on short-term actions or volatility. I'm looking big picture. And options allow you to do that. They give you a bit of staying power because you have limited risk and so forth. And again, if I have enough time, that time component is going to work in my favor. Where you get yourself in trouble with options if you buy too little time or if the market goes against you. So those are two things that work against you. And that will decrease your option in value. But I'm going to put a stop loss in place at 50% of what I pay because mathematically, if I'm an option buyer, if the market goes the other way or I'm running out of time, those are the two things that I don't want to happen. I want to recover what I can and get half of my premium back, ideally. Well, let's talk strategy. That's what you're here today. Let's talk about how to trade with higher relative volatility. That's what's important because we're in that environment. Yes, we've backed off a little bit, But we're still in a heightened environment compared to where we were. Volatility has been cut in half, but it's still double what those lows were. So I'll answer some questions as we go forward, and we're going to be talking about the VIX as well. So we're getting into the VIX, high relative volatility, and how to take advantage of it, and what strategies I think can do that. Two strategies we're going to talk about. One is iron condor, and the second is cash secured put sales, and why those are important. So let's get into those. First off, let's talk about an iron condor. An iron condor is a very simple strategy. We're taking advantage where the market doesn't go. So people could be, or may be familiar with credit spreads. What you're doing is you're selling a higher, you're looking at where you don't think the market's going to go, and you can profit by selling a higher option and then buying an option above that as protection. So if it doesn't go up to that level at expiration, you get to keep the premium. Well, the idea behind an iron condor is a combination of two credit spreads. The market can only go one way or another, and I'm going to show you an example here in a second. But the market can only go one way or another. So if you put a credit spread above and a credit spread down below, you're guaranteed to make money on one of them. Ideally, there are a couple of simple rules, and now the volatility has increased again. There are some opportunities. They're not as it's not as frequent as they used to be 4 or 5 years ago when volatility was higher, but volatility has fluctuated a little bit, and there are some stocks that move that you can take advantage of this. The idea here is to ideally find a one-to-one risk reward and to make sure that the probability is near as close to 70% as we can. So let's go through a couple of these. What's also very important is to use time decay in our favor. So when I talked about buying time, if I'm buying a call and I'm waiting for a market to go up, I want as much time as possible. If I'm selling a credit spread to someone else, I want as little time as possible for the market to go against me. So ideally, we want to do this 30 days until expiration, typically around 21, 25 days, because that's when the time decay curve starts to work more dramatically. So let's look here at a couple of examples, and then we'll see what we can come up with here. All right, so if we look at something like an Amazon, the idea here is to profit not from where the stock goes, but from where it doesn't go, if it stays within a range, within a range. So we can see right now, Amazon is trading at $530, okay? So it broke out of this sideways range where it traded sideways for a long time, around the 420 level, I guess, between 420 and 440. Then it took off, and now we're kind of tracking around this 540 mark, let's just say. All right, so if between now and October option expiration, which is the third Friday of October, if it can stay below a certain level and above a certain level, we get to keep that premium. So let me go through the process of constructing. Let me just double check that everybody's being able to see my screen. Check my audience view. There we go. Constructing an iron condor. Again, don't be afraid. It's essentially two credit spreads, a credit spread up above and credit spread down below. So don't be intimidated by that phraseology anyways. Okay, so let's say that I want to go to these October options. We're trading at 530. What option could I sell up above? In the high in the stock is about 580. So let's say I sell something $20 away. So let's go with the 550 call and then buy the 560 or something of that nature. Let's go higher. So on the upside. So what we're counting on is that the stock's not going to be above 550 at expiration. Okay. All right, so I want to sell the 560 call. I want to create a spread here. I want to sell the 550 call. All right, but I don't want to be naked because if the market takes off, that could be trouble. So I'm going to buy a call up above it to offer some protection. And let's just start with the 555, and we can widen that out if we need to. Okay, so the 555 call. So taking in about $1.50. All right, so this might be advantageous. Now, if Amazon is below 550 at expiration, I get to keep that premium. It's that simple. Well, but let's add to that. Let's add to that in the fact that let's put something on the downside. So that was 20 bucks up above 550. Let's go to 510, 505. So I want to add a put. I want to sell a put down below. And again, the idea here is the market can only go one way at a time. So I want to sell the 520, but I need to be covered. I want to have absolutely positively limited risk no matter what happens. So I want to buy some protection. So I'm going to buy the 515. And I'm just constructing this off the top of my head here. Oh, this one's, I want this to be a put. Sorry. Buy a 515 put. All right, so we're taking in almost $3 on this. If you split the bid and ask, let's say you could get 250, okay? So the maximum risk on this is the $5 differential between 550 and 555, or 520 and 515. You can see that $5. Now we're taking in $2.50, so the most we can lose no matter what happens is $5, and we're taking in 250. Our maximum risk is 250. So we're risking 250 to make 250. Now, the magic here is if the stock finishes between these break-even points, 514 and 555. And here, if I click on Analyze, we'll be able to see this is what we're looking for. But what is the probability? All right, so probability, okay, is going to be nowhere near what we want. Expiration's on the 17th, but I wanted to make sure that we had the risk-reward and we had the graph that we were looking for. So let me just edit this strategy here, because I want to make sure that we're getting at least 250. Create order. That should help out the probabilities, but still. Okay. Okay, so what we're looking for here is the break even on this is 517 and 552.5. So obviously, to make this happen, we're going to have to widen out those wings further, because this seems to be a little bit close, a little bit narrow, close to compared to where we are in the market. So you can see the probability is very, very low. So if I look at volatility in Amazon, Amazon may not be high enough to be able to do this iron condor strategy. But I want you to understand more the order. What we're doing here is we're selling a call credit spread up above and selling a put credit spread down below. I'm looking for a one-to-one risk reward. So that's really the process that I want to give you for today, and what to be looking for is to profit from not where the stock goes, but from where it doesn't go. So I would investigate, I would look at something like Apple, I would look at something like Priceline, I'd look at Tesla, I look at some of these bigger dollar stocks that have some movement, have some volatility, and look for it to stay within a specific range. I was looking at Netflix, but Netflix has earnings on the 14th, and these October options expire on the 17th. So that's not something we want to take into our earnings, because that could be the type of catalyst that could give the market a big, big spark. So what we're counting on is the market not moving. So if you have an opinion that you don't think a stock's going to have a big movement over the next 25 days, this iron condor strategy is right for that. Another thing to always say is, if you're going to put this on as a spread, you don't want to leg into it, you want to take it off as a spread. That's critical. That's very important. The other strategy that I want to talk to that I think is very suitable today, there are a lot of candidates, is the option wheel. The idea here is to sell cash secured puts. Now, cash secured puts have the same mathematical risk as a covered call. What you're doing is you are selling a cash secured put on a stock that you want to own at a discount or get paid not to, and it's something, you know, like you wouldn't do with a covered call. You wouldn't put on a covered call on a stock you weren't prepared to own for the long term. So if you have shares of, I don't know, Microsoft, or let's look at a higher dollar stock. Let's say you have shares of IBM. You know, you do a covered call on it, and you take in $1 or $2. If IBM sells off $30, that $1 or $2 isn't going to help you that much. You're committed to the stock long term. So the idea here is to use this as a step to get into a stock at lower levels. By selling a cash secured put, you have the money in your account, cash secured, to buy the stock lower if you do get it put to you. So this profits if the stock goes up, if the stock goes sideways, or even if the stock goes down, as long as it doesn't go down below your break even, and that's something we'll talk about here in a second. So the idea here is to identify high probability trades that you can get a return of 3, 4, 5, 6% in a period of less than a month, because then you can look at those annually. And it's something you can do on a monthly basis to generate regular revenue in stocks you want to own as a way to get into a stock at a lower level. So that's very, very important. You're prepared to own the stock. You're not doing this on margin. You have the money in your account, and typically we're going to talk about lower price stocks so that you can, you have less exposure. A lot of times there'll be single digit stocks. You can do this in addition to your directional trades. But I always, get some skepticism by people say, okay, listen, if I get a 5% return in 30 days, that's not that big a deal. But if you can do that on a consistent basis with a 70-75% probability and you do it every month, that adds up over time. Take those small returns and multiply them up over the course of the year, annualize them, and a good rule is the rule of 72. To figure out your annual return, take 72 divided by your annual return, and that'll tell you how long it takes to double your account. So to double your account, if you can get an 8% return annually, it would take 9 years. So that's very reasonable. That's why I want to demonstrate that small returns really, really add up. That's very important. Also, this is an investment manager trick. You could put in an order, say, listen, I want to buy Tesla when it gets down to, whatever price, okay? Put in a limit order, let it sit there, and if it gets there, great, you pick it up. Or I had a friend that had a Tesla and was waiting to buy Tesla when it got down to $200 a share. I said, well, why don't you just sell a 205 put, and if it gets down there, you'll get it put to you. You're getting $5 premium for the 100 shares, so you're getting $500, and for every month that you do that, you're getting paid, or when it does go down, you're going to get it put to you, as opposed to just putting in a limit order. So it's a way that investment managers get into stocks they want to at a discount or get paid not to. So let's go into this option wheel. Stocks you want. I can't stress that enough. It's a way to build a long-term portfolio. It's also a way to generate shorter-term revenue. Only stocks you want to own. I can't stress that enough. These are stocks that you might have to hold on to for months, maybe even years. So a lot of times these are low-digit stocks, but you're paying for them in cash, hence the name cash secured. And I think this is an ideal area to look at some single-digit stocks that have had some major sell-offs that may have some bounce back or some corrections in the next months or years. Typically, these stocks will have high relative volatility, and they are lower price stocks, single digits. So let me give you the example here. Sprint. Sprint was trading around $5, and I'm sorry, trading, what is it, $5.50 or so. $5 had been a very significant support for a couple of years. Okay, Sprint's a low price stock. What's the downside? So at the time, last August, you were able to sell the stock was trading at $5.60. You could sell the $5.50 put for 20 cents. All right, 20 cents is not a huge amount of money. But what that does is that gives you some 4% return in 3 weeks, which is very, very important. So what happens is it profits if the stock goes up, down, sideways, or even down. The break even was 6% lower than the price. So the maximum risk was $530, which was the cost, which was the basis price of that $5.50 put minus the 20 cents you put in. You take in actually. So you're getting 4% return in 3 weeks. The multi-year low was $5.36. You're buying down there at multi-year lows. So what happened in Sprint? Sprint bounced. Okay. So if you would have bought the stock, there would have been some opportunity to make some money. And with this strategy, you're limited. Your profits are completely limited to what you take in, which is the downside. But it's something you can do on a more consistent basis. So sold it for 20 cents. Ended up the stock had a 20% gain, which is a fantastic gain, and we only made 4 or 5%. But it was a high probability trade, and it's a way to get into some of these stocks that you may like. If you like some of these energy stocks, some of these metal stocks, some of these resource stocks, some of these stocks that have suffered, if you like some of these, there may be some opportunity here with this, using this strategy as a way to get in. And last October was a perfect example of that. Last October, JCPenney, Radio Shack, Plug, Cleveland Cliffs. We're not saying they're all going to bounce back, but what we're saying is they're not going to sell off dramatically in just a short period of time of 3 weeks or whatever it was. And if you look at those returns, 6, 7, 8, 9, 10% in 30 days is very, very significant, taking advantage of that increase in volatility. So let's talk about only stocks you want to own, stocks you may own for years, high volatility, low price stocks. It's a probability play as a way to get into stock at a lower level. So you sell the put, get into the stock. Then if you get into it, then you can sell covered calls, hence the name option wheel. You continue to sell covered calls until you get it taken out. So this is a strategy to take advantage of increased volatility and a way to get into a stock that you want at a lower level. So I'm going to talk about that here in a second, but let me answer a couple of questions. The first thing that I want to do in the chat box here is put in our offer. Our offer here today, and let me get the questions on my board here. Our offer today is I've got a subscription service, Bullseye Option, and you get trading alerts, you get a daily video, and you get market commentary as well. And that's a $7 trial that you can get at bullseyeoption.com/try. So I'm going to give you a 30-day trial for that, Bullseye Option 2.0. Online events, we're going to have some weekly webinars where you can ask questions. Like I said, my nightly Where's My Head At video with whatever I'm paying attention to on that day. You're going to get trade alerts, and I'll show you a trade alert from today in just one moment. I want to be able to find my questions so that I can answer them as we go forward, and I want to put this in the chat box as well, that link right there, bullseyeoption.com/try. All right, let me just get this and see. I'm going to have to enlarge the question box because I'm having trouble reading with this small font. So some of the questions are asked, how often are my trade recommendations? I get typically 1 or 2 a week. It's very specific trade recommendations, and I'm going to give you an example of that here in just a moment. Where to get in, what to buy, and where to put your stop loss, how much to risk, and so forth and so forth. So it's very, very straightforward. Very straightforward. Okay. So let me answer some questions here. High volatility stocks. Wouldn't NASDAQ stocks, typically a lot of high-tech stocks have a little bit more volatility to them. But right, that's just a measure of price movement. The more the market moves, the higher that volatility. And you can use that mathematically to your advantage. And that's what we're trying to do here. So let me see what other questions we have here. Because unfortunately, it looks like my window is closing. How about NUGT for selling puts? That's something I could look at in my my weekly webinar. Is it a stock that you're prepared, you have the money in your account to own at a lower level, and are you making enough return in the next 25 days, for the October options to make that happen? That's really the question that you have to ask for yourself. All right, if I show you an example, today, U.S. Steel. Selling the $9 put for U.S. Steel, and again, we are at the lowest levels we've been since 2002. Selling the $9 put, taking in 40 cents, the probability is 73%, and you're able to buy the stock 13% lower or get paid 5% not to. And it's a probability trade. It's a strict probability trade. Again, using that option wheel because we've had an extended sell-off without much recovery at all. So unfortunately, my power is going to drain out right here. Please sign up at bullseyeoption.com/try, and I will see you in my weekly webinars. There you go, bullseyeoption.com/try, and I'll answer the rest of these questions online, and thank you very much.